And now, as always, we wait a solid 1 to 2 seconds for this to connect live. And the great news is that, ladies and gentlemen, we are live, the TradingView show, with our wonderful guests, David Russell of TradeStation. Now, before we get going and dive into all things end of year trades, best performers, what's coming next year in 2024, and so much more, let me just remind you that this show is sponsored by TradeStation. TradeStation pursues a singular vision to offer the ultimate online trading platform and services for self-directed traders and investors across the equities, equity index options, futures, futures options, and cryptocurrencies markets. And before we get to David, I just want to remind everyone, David is the man who runs the TradeStation account on TradingView, publishing excellent ideas about all things markets, crisp, easy to understand charts. And always remember, you can follow him, follow the TradeStation account, send him a message, write him comments. This is him, the man, the legend. David, take us away with your disclaimers first, and then we can get into it.
Great. Well, Steph's great to talk to you and to everyone here. I want to just first start off by showing the standardized returns of certain ETFs. It's just something we do when we talk about exchange traded funds. We're going to reference some of them, especially the XLF and XLE we've been talking about. And just you can take a look at this. This is actually the TradeStation platform. I coded some stuff to actually make it show things like 1, 5, and 10-year returns. We were looking here at TradingView, but a lot of stuff I also do is on the TradeStation platform. And for people who like to be creating custom indicators and everything else, it has some interesting sort of functionality. Okay, so that's the standardized returns, and we can, if you want, we can start with the S&P, where we've often discussed things before.
David, I think that's a perfect starting point. I just want to make sure I give people this background again about why today's show is so important. And the reason why today's show is so important is because it is December 12th. You only have a few weeks left of trading in 2023. So for all of our viewers following us on TradingView or on the TradingView YouTube channel, this right here is sort of our presentation for you as you get prepared for not only 2024, but the last few months of trading. So let's dive right into it, David. This is perfect. S&P 500, let's go.
Great. So I've got a lot of lines on here, and I thought I'll just show them and then take them off one at a time, or one thing at a time to cover them. So this is the S&P 500. As you can see, we're now above this July high. And this is now kind of territory going back to early last year when the bear market was starting, around February, March of last year when things were crashing. We're probing those areas. But I wanted to point a few indicators out here. First of all, this Bollinger bandwidth. This shows the amount the market is moving kind of on a period of a few days. In this case, it's set to a 20-day period. But when it narrows like this, it means volatility is really coming down. Price movement is tightening. And this is actually a pretty interesting thing to see. Another thing here that's interesting is that historical volatility has been falling. So these things both tell us that one of the first things I want to identify on this chart are the extremely tight periods of consolidation that have occurred. So this was back here. It's pretty interesting if you look back in June, the market inched up, held a tight range, and kept going. It didn't pull back. It just held and continued. And that's often actually a very positive and bullish sign because it shows there's no sellers. It shows there's just money that wants to come into the market. So if you look what happened here when we rallied, in early November, we also just had this tight sideways consolidation. And then we had that good CPI. We moved higher, consolidated here for now several weeks. We have a similar sort of tight sideways movement, no pullbacks. I was expecting a pullback back into this gap, didn't get it. Many times, like when we rallied up here, I was expecting some kind of retest back toward 4,200, didn't get it. So there's often these cases when people expect those pullbacks and you don't get it. That actually means that there are no sellers. So that's what this market is telling us. And so I'm going to remove those now so we can see more. Another thing that's interesting is the rate of change. So it's interesting here is the market basically the 9-day rate of change. And then you can see that as the market stabilized, the rate of change fell because the market just went sideways. So the rate of change went to zero basically. And then it continued higher. So very often what we're seeing here is you see these kind of price thrusts. So you get these big punches to the upside, and then often you see it in rate of change. And then what happens is rate of change will make lower highs and price will continue higher. We had there have been some other ones like this I don't have them marked on here. I have them marked on a TradeStation chart, but the key thing is we had a really significant 9-day rate of change here in early November, and then we basically haven't turned negative since then. It means that money is just continuing to trickle into the market. So it's kind of like it starts moving, it kind of stops, and then it keeps moving. That's what rate of change is telling us. Next, we have the advanced decline line, which actually is hitting, I believe, let me make sure, it's hitting new highs. So the advanced decline line, which tells us the participation in the market move, is hitting new highs. So this is also a bullish confirmation, a breadth-based confirmation. This is what people call market breadth. I just mentioned what I think is interesting, really, really quickly as an aside. The names that are interesting to me are ServiceNow and Adobe. These are those kind of like, those are the second tier names. Those are like your, your guys a little bit lower down the ranking. That those are your workhorses of the indexes. Stocks like AM, AT. I haven't looked at them for a while, but some of these CDNS. Some of these are not the big names, but these are those second tier names that are showing that there is participation across the market. And then we have other names breaking out. I'm going to get to like Ameriprise. Who's ever heard of names like this? But there's a lot of S&P companies that are breaking out now. So let me just go back to the index really quickly. I want to just show those are examples of what the advanced decline line is actually telling us. So I did this. We did an idea here recently. It was called New Highs in the New Year. And we did it back on November 21st. And the really important thing of it was, we had identified this price gap that we went up and pushed through. But the really important thing in it was actually this chart of the NASDAQ, because the NASDAQ at the time had its highest weekly close of the year. And now if we look at the NASDAQ here as well, what we can basically see is the NASDAQ basically gapped higher and it held that gap. So these were high weekly closes. So it's interesting when you see something make a higher weekly close, it might just sit, might pull back a little, but it's kind of like once it does it, it starts to thaw out that sort of fear. And if it doesn't have a major like reversal or rejection, then that money again starts trickling off the sidelines a few kind of weeks later. And then the other thing, let me see, I had this other
David,
chart. Let me make sure
David,
go ahead.
I must say, I want to say that your usage of the advanced decline line and rate of change indicator was really cool, because those are indicators that often aren't discussed actually that much, despite them being built-in popular indicators. So the way you use rate of change was very interesting to me. And if I understood correctly, it's sort of you see that spike in rate of change, which sort of shows that there's a trend change or there's some sort of dramatic event, and then from there it flattens a little as one side or the other takes control. Is that sort of a way to think about the rate of change in this example?
I would say it's you could say one side takes control, or simply it's like something starts moving. It's kind of like if you're like, think of a freight train, like when it starts moving, it goes clunk, 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 like one car moves and then it stops and back and forth. That's kind of the way this thing starts to happen. So the key thing is that, maybe the train starts moving and it stops for a second, but then it keeps moving. And that's really, I think the key thing is that, it takes time for all those pieces to fall into place, because you're talking about thousands of people, millions of investors, maybe thousands of institutional investors, trillions of dollars in money. So it's not like it's just one thing. It's thousands of individual decision makers on the margin stepping in over a period of 1 to 2 weeks, which when you think about, I mean, it might be kind of a strange way to think, but, I think in hourly bars, so during the trading day, you have basically this period of time, 6.5 hours that you can be placing trades. So people are going to wait, something like 12, 18 hours of bars. Something moves, it pulls back for 2 or 3 days. That's like 10 to 15 bars. And then there's continuation. So what happens is that in many ways, these moves happen, and then people are waiting over these periods of hourly intervals, which translate into a few days, and then they start nibbling in. And in my view, that's really kind of the way to think about it. And if they're going to have a confirmation that initial move was real, that rate of change will basically not go negative. And also what you will now see is if the market continues higher, the rate of change will now start to make lower highs. And that's not necessarily bearish, but what it means is that you get that initial thrust, and then going forward, you continue to move, but you don't have the same. The initial acceleration is the signal. And as long as that doesn't go negative, it confirms that there is a move.
The visual of the freight train is perfect. I immediately saw it when you put together that visual with the movement and the rate of change indicator. And one more question I had for you before we move on, because I do agree with you when you mentioned Ameriprise and sort of who's heard of this name. Those are, to me, some of the most fascinating symbols, because sometimes that's really where the alpha is, looking where no one else is really looking and finding these moves before people. But you showed the idea that you posted from the TradeStation account. And I'd love to talk about that idea just a little bit more, because you show the Fitch downgrade. And that's so interesting that Fitch downgrade, I guess, was a sort of a contrarian indicator of sorts. Tell us a little bit more about this idea.
Well, I think it's one of these things where, when a pullback is starting, everything is bad news. And so we had a strong GDP report, and that was bearish. And then another thing was bearish. And in my view, there was another thing that happened here where somebody, I can't remember what it was, Moody's did a review negative, one of these, during this rally. And the market was red for like 2 hours. So basically, I think the key point is if you want to look at the chart, the price action, the trend, and the news that happens is just kind of news. If a good stock is trending higher, it gets downgraded by an analyst, it'll pull back, and then it'll continue higher. If a bad stock is trending lower, it might get some kind of bogus upgrade, and then people sell that. So the key point is that you really want to focus on what the trend is. There was a lot of signals here of a reversal pattern, and that was just kind of like an extra slap in the face to the bulls back then when Fitch did that. The real thing was you had this bearish outside day on a strong GDP report in late July. We were entering the summer months with that seasonal time when things are weak, especially when you're going into August. So it basically created this perfect sort of setup. But I think the most important thing is we really want to focus on what the charts are telling us, what the indicators are telling us. And usually the news is just kind of little catalysts that kind of bump it along, along that progress if it's going up or down.
And if you click the play button on that idea, let's see. Wow, how cool is that? Jeez, played it up. I mean, it's perfect. That right there should be in a technical analysis textbook. The way it played off of that, that's that resistance from the Fitch downgrade turns into support, then it breaks above it. Wonderful, absolutely wonderful. Okay, well, don't let me take us too far off track, because I think you were just about to either open up a chart of Tesla. Yeah.
Well, yeah, and I was just really going to say this pattern here where we have this this coloring, you'll notice is not exactly, I drew this separately, but it also goes back to that same, it's roughly that same colored zone from the gap that we've been consolidating at here. So that's important. And I would just say with the NASDAQ, actually S&P 500, I want to emphasize this really quickly, weekly chart of the S&P. The S&P has gone through these periods of time when it goes through. This is a weekly, so we're looking at a year is about 100 weeks. So basically, we go. I think about this monthly, but you have basically moves of about 20 months of consolidation at multiple times here. A year and a half, a little more. It does this many times, and I think right now, if you look at it, we're in a similar period of time. So in my view here, the market, if you view this as a long-term secular bull market, we're actually in a spot now where the historical patterns would actually be consistent with a breakout to new highs when you look at the way this market has behaved over the long run.
That's a beautiful chart. Keep that open just for a second longer, because I love those data studies that go back in time and find these similarities. After all, markets have so much to do with pattern repetition. Some people often say we're a species that specializes in pattern repetition. And wow, look at that, 95 bars, 90 bars, 90 bars, 88 bars. And by the way, talking about that 665 days since a new all-time high, I tip my hat to you for bringing that to our attention. I want to say 2 months ago now. So for all those viewers, this is why you watch the show. And that's the longest. So that's the longest streak without a new high in the S&P 500 for more than a decade.
Yep.
Wow.
And and I think that ultimately, if inflationary things were not working out, we could have a longer period of consolidation. But at this point in time, I got to show you this really quickly. No offense, not a TradingView chart.
It's okay.
Look at this chart. This is the money in money market accounts.
Oh my
according to the
gosh.
Fed.
Oh
So
my gosh.
there's cash on the sidelines, and this is the reason why the pullbacks have been so tight. There's no sellers. There's people who basically need to sell their cash and buy risk assets, you know? So,
David,
I mean, that's kind of,
David, we get a lot of new traders and investors on this show coming to the platform. You probably meet a lot of new traders and investors as well. Can we quickly just tell them what a money market fund is? It's essentially just holding it in cash, correct?
if you open a brokerage account and you put in like $10,000 and you just don't do anything or trade any stocks, it's in a money market account. You know, money market account is something where it basically invests in short-term treasuries, and it, you know, is safe money, so to speak. It's essentially just cash, earns small amount of interest. So, you know, this shows that there's a lot of cash. And what's interesting, if you look at different moments in time, like when the market, look at March 2009, when the market, this is when the S&P 500 bottomed, you'll see that money left money market accounts. So the thing is, if you look at different moments in time, I'm not sure exactly how all these things match up, but the key thing is, you know, this is also the bull market. There was a bull market that started right in here as the money markets were being worked down. So, you know, this is actually, you know, a thing that shows there's money on the sidelines.
Fascinating, and that this has not happened often to have. Well, it's a record of amount of cash in money market funds, with markets actually being, you know, somewhat stable. So yeah, I agree. And if that FOMO ever kicks in, where a lot of those money market funds feel like it's time to get back into the party, start drinking the punch again, then holy cow, that could be quite the slingshot higher. Great chart.
Great. And let's see. Before I get to Tesla, I did want to just quickly mention that on the NASDAQ, we had this gap, you know, and this was like, if we look at this, I'm going to just take off these indicators really quickly. And, you know, I think it's important to realize this is the weekly high on the NASDAQ here. That was when I did that TradingView idea earlier, you know, on the S&P. The NASDAQ, you can see, had its weekly close was above those previous levels. And that was really the green light that triggered me to write that idea about new highs in the new year. So when you start to see, now I don't have time to go way back, but if you go back and you look to those other moments in history when the market started breaking out, what you'll see is you will see weekly closes that are above like the year ago or a certain period of time. And that will start to confirm. And once you get those weekly closes, that wakes people up. And so that was a signal. And I want to kind of mention that because the NASDAQ is a dominant index that the biggest companies are represented, like Apple and Tesla, you know, Microsoft. So when you see the NASDAQ close at a new 52-week weekly closing high, that was a key signal for me.
And those types of, well, I want to say looking for closing highs, if you want to speak to that, and finding those specific highs is such a fantastic data point. Once again, not only for new traders, but for someone like myself, I've been in markets for 10 plus years. I've never fully grasped why it's so important to focus on these types of highs, especially closing highs. Do you want to comment on that quickly, just to tell us why that's important? Is it sort of the last trade of the day is the most meaningful? Is that sort of the thought process there? Or?
Yes. Well, I think it's one thing is that you typically have institutional money will flow in late in the day. I mean, if you think about it, if you have money in a 401k and it's 2 p.m, you say, I want to move X money into like an S&P fund, you know, that those orders go through, and some guy sitting on a desk at a major institutional, you know, one of the mutual fund companies has, okay, I need to buy X billion dollars of S&P. Those orders trickle in during the day. And, you know, so that's something that happens. And I think one of the other ways to think about it is just that, you know, if there's people who want to be buying or selling, you know, the early activity is not really where it necessarily happens. It just plays out over the course of the day. And the day, you know, the close is the culmination of all the forces at work in the day. So if you close at a high, it means that the culmination of forces was toward the bulls and toward the buyers.
Fantastic. The culmination of all the forces in markets, you can see that with the last closing print. And I also would add to that I've heard something similar about how, I don't have any stats to back this up, I just have heard it from various professionals, that a lot of the big money or institutional money does prefer to work on the back half of the day. I've often heard that. Fantastic. So what other charts? I think you were going to open up a chart of Tesla. Is that right?
Yeah, here, let me show you Tesla. So basically, I was just watching this, and to me, this is just, This is kind of on watch for me. They report deliveries early, early in January for the quarter. But, to me, there's been a lot of, potentially problematic things about, Tesla and the autos in general, price cuts and everything else, worries about China and a lot of other things. And I just want to mention that it's interesting that Tesla is not participating in these highs. And it seems to be trapped in this channel. So the thing is that if you have a pattern and a formation like this, there could be a time here where it's going to work its way down this channel. So we published this idea and it's been continuing to just move sideways since, as the rest of the market's been inching higher. It seems like Tesla is kind of challenged here. And I would just say that if it doesn't, manage to break out of this channel, it could see, some downward movement. And, there's people, if they're going to buy a mirror prize, they have to sell something to buy it, right? And I think that's really the point, as these new stocks enter the market. And that's one of the things I want to mention. And it actually allowed me to really quickly show something from my TradeStation account, because this is one thing that maybe you can do it on yours, but I'm not sure. Where'd it go? All right, so over on this TradeStation, there's one of these charts I have, and it shows that the S&P companies making new 52-week highs. And you can see right here that today we have more companies. This green line down here is showing more companies making highs in the index. This is also an advanced decline line. So this is really kind of showing that there's more money kind of coming off the sideline in the S&P, or, it shows new companies are making highs. And that's another conventional sort of breadth-based analysis of the market, when you have more companies making highs or more companies crossing above the 50-day moving average. And a lot of that data we have on TradeStation, this red line actually shows companies above the 50-day, things like that. These are things I cover in my other webinar. I wanted to mention 72 stocks above the, making new highs. That is the highest level. It goes back to June, but it is just kind of interesting to see that as a confirmation. What's also interesting is once you start making those new highs, if you actually see the market hit that level in June, and then the 52-week highs actually trended down as the market trended higher. So if you're making new highs on the 52-week highs, that actually is a signal that there's likely to be in the following weeks upside, because that number will start to give a bearish divergence before the drop happens. So if you are making a new high on that, it actually would indicate that the market has more highs ahead.
So I'm writing down show notes as well while you chat. So for those following along in the live chat, they can catch up. And then, of course, when we share the link out, go live on YouTube, people have these perfect show notes. So if anyone sees me typing, that's what I'm doing at the moment. At the same time, what I really wanted to ask you was about this Tesla chart, not participating in the rally, and that relative trade. Maybe sort of walk the new trader or investor through that one more time, because it's to people like you and I, it's I'd say now it's an obvious concept. It means that while the market's going higher, maybe some equities are being left behind. Why do you want to be with the equities that are left behind when all these other stocks are breaking out? So maybe just tell us a little bit more about why these divergences are so important to follow.
Well, I think it can tell you essentially, where money is going and where it's going away from. And in this case, this tells me that there's really no excitement. I mean, Tesla's a name people get excited about, but then when they're not excited, it's one of those things where, it's not a cheap stock. You can't make a value argument for it. And if things are going to go from good to bad, then they can go down, a lot. And that's the way a volatile sort of high beta stock is. So I think in this case, it's really a question of, people have a portfolio and they have a certain percentage and they're going to try and follow the index or the names that are giving the outperformance that they're focused on. And there's a lot of people who buy Tesla hoping that it's going to double. And the thing is, if it doesn't double, they're going to start selling it. And that's really the risk is, that if Tesla fails to participate, when something bad does happen, there's probably a bunch of people with stop losses here, probably around 225, 230 or something, which means that if it breaks through this level of the 200-day moving average in the same area, you could get just a cascade of just sell orders. And I think that's really the risk in a name like this right now. There's people buying it or hopeful that it is going to catch up. And then if it doesn't, but I think it's always on the margin and it's relative. And to me, it's very interesting to see this relative weakness in Tesla at this time.
So I have to say that on that note, you said something that I think is so cool about knowing the expectations of a stock, or maybe knowing you know what it came to mind was knowing its personality. And speaking of
Yeah.
Tesla, for example, it is still such a, hot stock or stock with a lot of expectations. Exactly. A lot of people buy it saying it's going to double, triple. So what happens when it doesn't? That was a really cool comment. I never have considered that about stocks, that they have this type of personality. All the buyers are giving it a personality to be aware of. So this chart is very interesting, especially because as we all know, Tesla has been such a winner for such a long period of time, that to not see it participating is something to note, especially as we enter the new year. And are these the charts you're looking at as we enter the new year and sort of formulating your outlook? Do you have an outlook at this time, or are you fairly agnostic as we go forward?
No, my expectation is the market will, the odds favor continuation to new highs, for many reasons. And I'll just say really quickly that I think one thing that's really underappreciated is that the American economy before COVID was actually recovering from the financial crisis. And we are also recovering from a period of time when we had globalization that reduced economic production in the United States and reduced incomes and reduced employment. Those were both processes that, lasted a long time. The globalization started around the year 99, 2000. The housing crisis started in like 2009. And then basically we had a period of time when the American economy was, growing 1% a year because of that double whammy of those two long-term trends. And what's interesting is those trends were ending before COVID. And then COVID happened. And now, as we're getting back on a horse, so to speak, we actually realize that we have some really positive tailwinds that I think are completely underappreciated by most investors. I think we have to realize that the inflationary thing that happened is, a negative, but at the same time, there's no real reason to see it as being a structural thing the way we had in the 1970s, when you had a lot of other things that were happening that are not happening now. So I think 1970s, a lot of people don't realize, is you had very strong economic growth in the emerging world and other countries. You don't have that now. So you don't have the same, you didn't have the Vietnam War and a lot of other things like that that had actually caused this inflationary spiral. So now I think we're in a process where as inflation winds down, people are going to start to realize, wow, there's good things happening. And I think as we get into an election year, there's going to be more of that sort of focus as well. That historically, when you go into election years, sentiment improves. And if you look at the last consumer sentiment report last week, it was extremely positive. It showed a significant change in sentiment. We saw the S&P does an annual or some kind of weekly report. I'm not sure exactly what this survey is, but I've seen it in the last few weeks showing the significant improvement of investor sentiment. So we've had significant negativity ever since. I mean, it really started before COVID, and then it got worse. Coming out of COVID with inflation, consumer sentiment at very low levels. And I think what's going to happen now is there's a good chance that as the reality of falling inflation and strong employment actually continue, and the negativity associated with COVID and maybe political unhappiness improve, we're actually setting up for a situation where we could start to see a significant improvement in sentiment. And what's interesting is when you look at the VIX, which I want to mention that, actually let's look, everyone mentions the VIX. One of the things that's interesting to me from an intramarket analysis is, the VIX here, we had talked a while back about, I can't remember when, we talked about how it was holding these levels from before COVID and now it's breaking them. But I would just say an interesting thing also, if you look back to when the market was a bull market in late 21, the VIX was, it had come down a lot, but look at now the 200-day moving average on the VIX is much lower than it was back then. And what this is really telling you is, this didn't last. And now we're going into the spot where a lot of it very well could. And the thing is with that cash on the sidelines, that correlates to the VIX going lower. Because the thing that really causes, the VIX to spike is very often when people are leveraged, they borrow money, they buy stocks, they're complacent, and then it crashes and you get margin calls. That is what really causes a volatility spike. And we have the opposite of that right now. So I think it's important to realize that this movement in the VIX as well is something of a confirmation of the sort of idea of the market continuing to new highs.
I have to say that is Fantastic analysis of the VIX, because it takes us back to the money market comment, which is that perhaps the market in the VIX is starting to put this puzzle together, that there is this much cash on the sideline. So even if there is a little bit of volatility, there's a record amount of cash in money market funds. It'll soak up that volatility rather quickly. Thus, how would the VIX ever have a chance to break out? That is it's just something that I need to keep my eyes on. I need to add the VIX to my watch list, immediately, or at least drag it up to the top of my watch list. One more comment for you. So 2024 is an election year. That's such a good note as we do this end of the year show. I have not seen many people discuss that aspect, that's an election year. Can you maybe provide some commentary on how to think about election years? I think you mentioned that historically the data does suggest that they're bullish. Is that right?
Historically, election years are good for various reasons. And I would say that in many cases, we face a lot of, I think right now one thing that's interesting is the Biden administration is making real efforts to drive down oil prices. They dropped sanctions on Venezuela, and there's a lot of things that they can do. It's interesting that for a while, the government was encouraging oil companies to buy back stock and not invest in oil wells because they wanted to encourage, green energy. Now we're actually seeing the opposite. If you look at various reports, there have been a series of reports recently of Chevron, Suncor, all these different companies massively increasing the production plans for next year. So I tend to think that, I'm not sure exactly that the Biden administration is encouraging it, but I tend to think when you look, we've seen oil and gas production in the United States hit record levels. And I think that that's an example of some of the levers that politicians can pull in the background to make things get better. And we're going into a Christmas season and a new year of oil crashing, energy prices coming down. In fact, really quickly, I'm crude oil futures here on the weekly chart.
Yeah, I'd love to see this chart.
We got to recognize that we're now on pace for the lowest weekly close aside from when Silicon Valley Bank. This is weekly, so this is Silicon Valley Bank. We're on pace for the lowest weekly close aside from that. And after that, you have to look back to basically before the Ukraine war started. So this is crude oil futures. We did this idea on TradingView about XLE, the energy ETF. And what I'll just really quickly mention is we talked about how it basically had this level. And if you look back to the idea, you can see here, this was a close and we just tried, couldn't get through, broke below. Now we're closing at new levels here. And, we had talked before about this long-term weekly lower highs on the XLE. And what's interesting is it also has this uptrend that started coming out of COVID, and now it's breaking. So for me, I think one of the things is that, the world, people kind of, one of the stories before COVID was that OPEC was basically coming unglued, and they are now falling apart again. They came together to cut production during COVID, but now you're starting to see, the Russians are pumping oil. They brought in Brazil, even though Brazil's increasing production, and they still brought them into OPEC. So I think it shows that now these are trends that people don't talk about, but they're real. Trends can be real even if you don't talk about them. And I think one of the trends here is that American oil production, I'm not going to get the chart here, but if you Google and look, there's articles about it now showing that American oil production is going through the roof. At the same time, OPEC is not able to rally its people together to cut production. So what does that mean? It means downside in oil. What does that mean for inflation? What does that mean for politics? And then what does that mean for the S&P 500? So I think for the most part, oil is inversely correlated to the S&P 500. And if oil goes down, that will essentially be a positive. I'm going to predict exactly, but historically, downside in energy means lower interest rates, higher consumer sentiment, and higher stock prices.
David, that was a wonderful breakdown of oil prices, especially because there was so much there that I was not fully aware of, and potentially a lot of viewers were not fully aware of. The aspect to of going into an election season or an election year with oil being a headline, I was thinking as you were explaining this as well that, that's right. It's in an administration's best interest to push oil to go lower, to make the economy better, everyone happier, cheaper gas prices, more goods you can purchase, because happier people, of course, may lead to better voting results. So a lot of that, I was putting the dots together there, and that was a wonderful explainer. In fact, we wrote in the chat just that oil traders need to listen up here. You know, if you need to rewind and listen to what David just said about oil and following oil markets, I suggest you do so, because that was awesome.
Now, I have one concern, and I was kind of personally shorting some of the energy stocks, and I'm done okay in it, and I closed that position actually yesterday, and the reason is because I'm noticing, like I said, the incredible breadth and things like that, and my concern is that I'd be careful of being overly negative on the energy stocks at this point in time, simply because of the fact that there's basically when you have so many stocks participating to the upside, there could be a day when we start to see money flow into them. So at this point, I want to make clear that I think that some of the move, that the easy money has probably been made to the downside for now. But I mean, I also think it's important to realize that, energy stocks don't have to crash. As long as oil just kind of doesn't go shooting up anymore, it will pull down inflation. And there's a good chance that oil will continue to grind lower, and at a certain point it could cascade and really break down. We're not probably to that point yet, but I think it's something we have to have on our radar as a potential. So.
Before we dive into housing and on what you're saying here about the trade in oil, could you go back to the futures chart that you had open of crude oil futures? Because I think it does highlight the aspect of, so I noticed all these weekly red candles, and when I do see that, it's the trades kind of happened. I think that's 1, 2, 3, 4, 5, 6. It's it's 8 or 9 consecutive weekly red candles there. So that's quite the move and quite the way to head into 2024. Are you showing us one of your custom coded scripts?
Yeah.
Oh, that's a great script, and that's from TradeStation.
Yep, this is one of ours on if you go to our brokerage account here and you go to scripts. It is called Price Streak. We did it several years ago, so it's somewhere here if you look down the list. Price Streak did this. Wow, can't believe this. I did it in February of 2020. I'm feeling old now. So anyway, so I mean, I think with oil, and there's some support here, I think, and I think this trade is there's likely to be more of it, because when oil moves, it tends to move in a one-way direction because of the fundamentals behind it. However, I think at this point also, it's at a spot now where the risk reward is not as favorable, as it was previously.
Well, I'm sharing the price streak indicator in the chat because indicators are off. I see a 448 boosts on that and quite a few comments already. And indicators are often loved on TradingView, especially, I mean, this is a really cool indicator. If you ever want to see a specific streak of an asset, how many consecutive red or green candles has it had? That's a very nifty and helpful way. Okay, let's get to the housing sector. I'm so fascinated by this chart. As a possible home buyer, though, it's a little depressing. I was hoping to maybe see the housing index go another direction.
Well, it's interesting. I actually think you might be in a better spot, because the thing is there's a lot of people who are not. There's no transactions happening. And as the market unfreezes, there's a lot of people who want to move, and they are going to put their houses on the market. And we're actually going to have a lot of inventory hit the market. And I think there's potential for prices to come down. So if someone in your spot, if you're renting now, it might actually favor you. The people it might be hard for are those people who want to sell a house and buy a house, because then everything is going at once and they think they're selling for this, and then they can't get it, and that they don't know what they're buying, and that's tricky, but it might actually not be so bad. So I hope it does work out for you. Anyway, the HGX housing sector index, I mean, it's people don't look at this chart a huge amount, but it's pretty interesting to me. Look at this now. Look at SOX, the Philadelphia Semiconductor. I mean, it's doing well, but it's not at new highs. The NASDAQ is not at new highs. The XLK technology ETF. Actually, wait, you know what? That one is at new highs. But it's interesting just to realize this is sensitive to interest rates, and to see this breakout to new highs, I think that actually says a lot as we go into the new year. And one of my expectations, I have some things that I'm going to be publishing an Outlook piece, but I can kind of tell you that, like I said, I think we're going back to this kind of not just a pre-COVID normal, but a pre-2008 normal. And I think that's a really important thing to recognize. And that's going to be one of my key themes for 2024. And I think that's one of the things that this chart is telling us. When things break out to new highs like this, there tends to be continuation and momentum that can last for quarters into the future. So from my perspective here, something like what we're seeing in the HGX, this actually confirmed to a certain extent that interest rates are pretty much, the market at this point has a lot of confidence that interest rates are done, going up. I mean, at this exact moment in time, yields have come down a lot. And there might not be much movement on them or anything, but there is confidence here that this is going to be a big year for housing coming up.
So, and on that note, so this index also is measuring a basket of housing related stocks. That's the way to think about it, right?
Mostly the builders like Lennar, Toll Brothers, those guys.
Got it. And so on that note, if the market is sort of pricing in this sector, to this extent, this breakout to highs, would you think that they're expecting interest rates to at least freeze or go lower? Because if interest rates were still going higher, I think that would be bearish for housing. So is this an interest rate indicator as well to watch this?
Yes, exactly. That's my point. And to see this, in my view, it shows that there's significant confidence that rates are not going to go much higher. I don't see anything really clear on the Treasury chart. This is a 10-year that you and I have discussed before. I have these different lines on it, and I don't have much to add to this. People have watched the other ones. You and I have looked at this a lot. We had done this as a monthly, and if you look at it here, it's kind of, we have this old high from '08, and from my perspective here, you can have just a period of not much of anything now in terms of up or down on the yields of something like the 10-year. But that doesn't really matter, because the thing is that mortgage rates will follow it. And if the market's looking out into the future, and if they see things like gasoline prices coming down or the potential for rate cuts at some point next year, the market will be able to expect and live with waiting for 3 to 6 months. I mean, the market can run up the home builders long before the boom happens. And then when the Fed, I would say from a trading perspective, when the Fed cuts rates, that's when they'll sell the home builders. It'll be buy the rumor, sell the news.
And ladies and gentlemen, if you were listening closely there, you just got a great example of what buy the rumor, sell the news means and is. If you're unfamiliar, it's a saying that has been going around Wall Street and trading circles, I want to say since probably the 20s. So listen closely, because that is some historic market wisdom that you just gathered right there. So fantastic chart on the housing sector. And once again, something that I need to add to my watch list and keep an eye on for these types of macro moves. And now you've got the NASDAQ 100 open.
I was going to bring up this chart.
Oh my gosh, the private equity firms, KKR. Tell us about this.
I think we talked about these last time. And I think the thing that was interesting to me was to see these stocks that are basically kind of like ETFs for the market, kind of, when you think about it. This is interesting to see the way these names have been moving. And I wanted to just mention the way that, Apollo, Blackstone, but I want to just kind of mention that this is kind of, it's interesting for me to look at these other things that are happening in the market, and in terms of some of these new names. So what's really interesting to me is we've seen the last few months, Airbnb was added to the S&P, then Uber was added to the S&P, and Mongo Database was added to the NASDAQ 100. Palo Alto Networks was added to the S&P a few months ago. So what do you have? You have relatively new tech stocks that are now added to the major indexes. And that's another theme that I want to focus on next year. I want to be looking at these names that went public 5 to 8 to 10 years ago that are, everyone knows Uber, but it's not as big as Apple. I mean, it's not Amazon. It's still like, I don't know how big it is. It's probably, not that huge in terms of market cap. So the thing is, I would look for basically these newer sort of mid-tier names that go from being big to huge. That, I think, now is going to be one of the trends people are going to watch for. This is true growth investing. If you look back at something like Microsoft in the 90s, it went up a lot, it sat, and then it went up a lot more. And I think that's kind of now the phase of the things that we're going to want to be looking for as we go into the new year. Another thing that was interesting to me, and I want to mention this one, I'm about to publish an idea on it, is
David, I want to quickly give the listeners and viewers context on this, by the way, because you spoke about that exact same concept on our last show, and I think the show before that. And I pulled up a percentage. Well, you have Uber up now, and I was just floored to see that Uber at 129 billion is up 20% in a month, 51% in 6 months, and 147% year to date. So that theme that you're telling us about these mid companies to maybe massive companies, or small to mid to massive, is something to pay attention and might be unfolding before our eyes. Look at this Uber chart.
There's a word for this.
What's the word?
Accumulation. It's accumulation. And so, this is the sort of thing of, I think that's what we're talking about. And this is people who are thinking, in 5 years, I want to say I owned Uber at, under 60. And whatever that is, when his stock could, potentially be higher. Long term, I think, I would, encourage people to go back to 1995, 96 and look at Microsoft and what it did, and then to think, all right, what's Microsoft now? What's the equivalent of a company that is, if you went back then, GE, Exxon were way bigger than Microsoft at that moment. But, it was the new thing that was taking off. And I think that's kind of the way people might want to think about this. We had done an idea on TradingView on Airbnb when it basically held right at that 50-day, and it kind of had the same sort of pattern. So it's another one that's on the list. Now, if I could, I want to mention that we are going to be publishing an idea in a minute on AIG. Now, AIG, I don't have a line on this.
That's a name I thought I would never hear again, but here we are. I can't wait for this.
All right, let's see. I gotta get this. I again, like I said, I have so many different charts, and I marked some up. And I think the one I was going to publish, I don't have visible because I didn't want to mess it up before I publish it. So basically, this is AIG, and then this is the financial crisis. Boom, right there. So basically, I mean, it's squeezing to that level. This is a weekly chart. Now I go back with some indicators on it. It's pretty interesting. Now, these are the things that are jumping out to me. First of all, if we look here, I'm going to take off. Well, the 20, and let me hide these really quickly. The 50, here's a golden cross of the 50 above the 200-day. Now, if you look at this line here, we basically have this high for the year. Look at how we basically resistance becomes support. And then that other line is basically right here. We're basically at the old, and if you go back on this weekly, you can see that we basically have this level from like 2016 or something. It's somewhere in here. There was this high somewhere through here that was the previous, the beginning of 17 right here. And we're basically at it. So, I mean, to me, this is pretty interesting because if this starts breaking out, I mean, it has upside. I mean, there's space on this chart. And it's one of these names that no one has probably thought about, literally for, a decade. There's probably kids who were born when this thing happened who are now like in college or in high school or something. I mean, I can't believe how long this has been. And this is a major stock. I mean, this is a huge insurance company. It used to be in the Dow. So, I mean, this is what I think is going to be one of these other things we see. In many ways, the financial crisis, it had to work its way through the system, just like housing. And now what we're really seeing, look at long-term chart of XLF that we've talked about before. XLF, this was 08, 07, 08. This was pre-COVID. And now look, we're holding again. We've held that level. So to me, financials, it's like, I don't know if you've seen the movie The Graduate. Maybe I'm dating myself again. But the guy says, I have one word for you, my boy, plastics or something. Well, I feel like right now, if it was that scene in that movie, he'd say the one word is financials, because you basically have an industry that has been it has been through the ringer, and now in many ways that the fundamentals behind it are kind of improving, and if rates come down, there's a perfect storm that could happen, I think, to a positive extent in the financials. So that's just one of the things I wanted to emphasize. We're going to be doing this thing soon on AIG.
The Graduate scene I'm aware of. Excellent scene. One word: plastics. And on this comment of financials, I just want to make sure, because maybe, like you said, a lot of our viewers and listeners weren't really active in markets during the financial crisis. You're exactly right. I mean, that's someone was being, born then, and now they're sort of maybe they're just getting interested in markets. But AIG was essentially one of the more talked about names as markets were crashing because of its precarious balance sheet and maybe some of the obligations or write downs it had to incur during that crash. It wasn't responsible for the financial crisis, but it was a big player. So knowing that that company is potentially on the verge of reclaiming its financial crisis high, not its highs, but the gap and back to those levels is just, I never thought I would actually hear that, because my mind sees the headlines about AIG, sort of the negativity associated with the financial crisis in AIG. I just did not expect that chart to come up, but for that reason, super cool and very interesting that that type of historic market moment is potentially returning.
And I'll just mention Macy's, Gap.
Oh, come on.
Abercrombie
Macy's is
Fitch,
breaking out? No
Intel.
way.
No, what I'm saying. Well, Macy's, there's the acquisition for them. Macy's,
Oh, right,
Gap,
right.
Intel, Boeing, Abercrombie and Fitch. So these are companies also that allegedly they were, they whatever, they were dead. They're all hitting 52-week highs now. So it's interesting, I think, to realize AIG is in that camp as well. And so I think that we have that potential that as breadth widens, these names that people have literally laughed at for a decade, that, and the other thing is we had the whole retail apocalypse, between like 2013 and 2018, when like thousands of, stores closed. That process is over now. And a lot of these companies that have survived, now people are starting to go back to them in a much more downsized version when they can have better pricing and profitability and everything else. And so the retailers are in that spot also where there's that value potential, with them. So I wanted to actually really quickly, there's another thing I forgot to mention on the S&P on the daily. This is something as an indicator I've used for trends: the 20-day, the 30-day, the 50-day, and the 200. I could also add the 100. It's not as relevant to this, so I should take me back off. But you can see here, as we enter this period of weakness right here over the summer, the 20 crossed under the 30, and then they were all in this bearish sequence. The 20 under the 30, under the 50. Now you can see they cross. So it's not the most immediately like going to give you great signals off the bat. But as a general rule to watch it, when you start to see this moving average sequence kind of lining up in the right way, or the fast above the slow, or vice versa, that's an interesting sign of trend. So I want to just point out that we now have that. Back here when we started rallying, we didn't. And so what's really interesting is this period of consolidation has really been a period of time during which the moving averages actually get lined up to sustain a potential uptrend.
Another masterclass for those who use moving averages on their charts, which is the application of not just using one moving average, but multiple, which I can see we have the 30, the 20, the 50, and the 200 day. That 200 day, by the way, is really sloping up and to the right nicely now. And that is what I find to be quite bullish there as well for the long term. I do want to go back to one equity symbol that you mentioned that I had to look up while you were chatting. That is Abercrombie and Fitch. And I looked at their, come on, who saw that coming? This is such a cool theme for 2024, which is, are the sort of most hated stocks on the verge for a comeback? And once again, it ties into your money market stat, because perhaps some level of thinking is all that money in money market funds can't necessarily just go chase the same basket all over again. Those same five stocks, Nvidia, Microsoft, and others have already made their move. Maybe it's looking for these opportunities that are rather contrarian. That chart, wow, I did not know Abercrombie & Fitch was up 254% year to date.
Yep. And well, that's what I mean. So I think we've been through an unusual time of concentration in those big names. And we're seeing a lot of evidence that it's, I don't want to say that people are going to sell them all and they're all going to be dead, but it does mean that if you see a name like Tesla and it looks kind of dead, that, to a certain extent, guilty until proven innocent might be a fair thing. I mean, we're talking about investing in trading. This is not human rights here. We're talking about the market, and we're talking about a stock. And if there's risk, presuming that it's in a period of weakness can be a safer course to take. So I'm just saying in that case, it's like people will look at it and they'll see it's not participating, other stuff is. And that really is, I think, a red flag people have to be careful of. And when something seems stuck, be careful of it, because then when something happens and the market does pull back a little, those can be the names that get hit hard. So that's just my last thought, to contrast Abercrombie with Tesla.
And that's a pair trade I must say is sort of fun to talk about, which is a short a stock like Tesla, long a stock. I mean, the Abercrombie move may have already been made. That's a pretty remarkable chart. Oh yeah, there we go. What a pair trade. Wow, you'd be having an excellent year if this was your pair trade. And what a great chart using formulas there, ANF divided by Tesla. And one more thing that I wanted to also go back to was your aspect of brick and mortar in general, which is, and this is us now just talking business strategy. Do you think that these types of comebacks are happening because maybe they figured out how to sell online? Do you have any commentary or thoughts there?
Well, that's going to be part of it. I would imagine some of these companies are going to have the ability to use new technology and all sorts of new ways of inventory management. They'll probably be able to start doing stuff of AI for customizing clothes, customizing stores. You might have different cities and they want to, in responding to different, preferences for different demographics. So I would imagine that will help them. The real story, though, in my opinion, is that basically they've been through the ringer in terms of downsizing. And if they were going to go bankrupt, they would have gone bankrupt already. And at this point, if they survived, it means that they're probably going to be in solid shape. And a lot of these companies have, essentially, they're not going to be in a spot when they need to be marking down inventory in a significant way the way they used to. And that was the real killer for them before. So that now they're in a spot where, they're not going to have that risk to their margins. And the other thing I just want to mention that I think we have to remember is that the concentration of the big names means that M&A has not been a theme in this market. But what happened with Macy's, reported, buyout potential. And so I think we have to remember here is that, these names are small. These names can have breakups. Gap owns Old Navy. They can break up. They can do this. They can do that. And those are the sort of things that start driving a new kind of narrative that we really haven't seen in the market since 2008. We have not seen activist investor as a narrative. We've not seen M&A as a narrative. And those things can come back. So I think we have to realize is, some of the different things are coming online. And those are new drivers we need to start learning and looking at.
So this is, as we hit that hour marker too, this is the perfect theme to end on, which is all of the things that haven't happened this year, even the year prior to that, or especially later in the cycle that year, maybe are on the verge of making a comeback. And we've already spoken about a few of those things, but one you just mentioned about buyout activity and activist activity, I would love to comment on and just add a little more background to that as well. I was just thinking the other day, I have not seen any major headlines that I'm used to over all my years in markets about, say, a hedge fund manager coming into a company and sort of shaking it up, making the splashy headlines, or some of these mega buyouts or buyout season. And, there was a point where every Friday it felt like there was a buyout or a merger happening. And it's just been a while since that happened. So this is an interesting way to end the show of, could we be turning the corner for these types of special events to come back to markets? In which case, a lot of these unknown names or underfollowed names are essentially back in play.
Exactly. And the big mega caps don't have that potential. So that's exactly right. And I think that's going to be part of the kind of market dynamic, into the new year.
Well, David, fantastic. Another great show. We're just about to hit that full hour marker. And I just want to make sure, because I like to do this on all of our shows, that all listeners and viewers and people who restream this, whether it's on TradingView or YouTube, know that David Russell is the man behind the TradeStation account. He is the head of global markets strategy at TradeStation. You may be sure to follow the TradeStation account on TradingView, because you will get some high quality charts in your feed daily. And in addition, I think one thing we discussed on this show about the TradeStation account and everything you're doing there is the scripts. We have yet to go into your custom coded scripts, and the script that can quickly show streaks in different assets was very nifty to me and something I'm going to utilize right after this show. So I just think it's key for people to know, follow the TradeStation account. You have this level of access. You can get these insights as you follow along. So thanks so much for joining us again, David. And it's December 12th. David and I will be back in January to go through the start of 2024. And hopefully this show gave all of our viewers and listeners, a blueprint of where we are as the end of the year nears and as 2024 picks up again. So thanks so much for joining us once again.
Thanks, Stefan. I'll see you soon. Take care. Have a good one.
Thank you so much, David. We'll talk soon. I'll see you.